Today, we will talk about the EV/2P ratio, a key metric used in valuing oil and gas companies. The EV/2P ratio is a ratio used to value oil and gas companies. It consists of the enterprise value divided by the proven and probable, 2P, reserves. The enterprise value reflects the company's total value. Proven and probable, 2P, refers to energy reserves, such as oil, that are likely to be recovered. The formula for the EV/2P ratio is EV/2P equals enterprise value/2P reserves, where 2P reserves are the total of proven and probable reserves, and enterprise value equals market capitalization plus total debt, total cash and cash equivalents. Proved reserves are likely to be recovered, and probable reserves are less likely to be recovered than proved reserves. The sum of proved and probable reserves is represented by 2P. The EV/2P ratio is a metric that helps analysts understand how well a company's resources will support its operations and growth. When the EV/2P multiple is high, it means the company is trading at a premium for a given amount of oil in the ground. Conversely, a low value would suggest a potentially undervalued company. It's important to compare a company's EV/2P ratio with those of similar companies and with the historical values of the ratio. Let us assume that an oil company has an enterprise value of $2 billion and proven and probable reserves of 100 million barrels. The EV/2P ratio equals 20, or the company has a 20 multiple. In other words, the company is valued at 20 times its enterprise value to 2P reserves. Whether the 20 multiple is high, low, or fairly valued depends on other oil companies within the same industry. The EV/2P ratio compares enterprise value to proven and probable reserves, while the EV/EBITDA ratio compares enterprise value to earnings before interest, tax, depreciation, and amortization. The difference is important when judging the potential or possible growth of an oil company, since proven and probable reserves are likely to be recovered. The EV/2P ratio includes total debt in its calculation because enterprise value also includes total debt. Oil companies typically carry significant amounts of debt on their balance sheets, which is normal for the industry. Debt is used to top finance oil rigs, equipment, and the cost of exploration. Investors should be aware of the unique capital structures of oil and gas companies when using any valuation metric, including the EV/2P ratio. Here are 3 key takeaways. 1. Enterprise value compared to proven and probable reserves is a metric that helps analysts understand how well a company's resources will support its operations and growth. 2. The EV/2P ratio is a ratio used to value oil and gas companies. It consists of the enterprise value, EV, divided by the proven and probable, 2P, reserves. 3. It's important to compare a company's EV/2P ratio with those of similar companies and with the historical values of the ratio. Hope this would help. Thanks for watching.